Okay, with second part here of Chapter 3, let's talk about the actual ratio analysis. Of course, we have to start with some financial statements. Again, one of the exercises that I ask you to do is to find some information about your company and input it into the financial statement spreadsheet that I provided. And of course, I've done that here for our company, Bartlett. So we have the 2 years. We have their income statement, we have their balance sheet, and let's talk about the ratio. So eventually we'll look at, in class, we'll actually explore this, but let's talk about the first category of ratios, which are called liquidity ratios. Liquidity ratios measure a company's ability to pay its short-term obligations. So the first ratio is called the current ratio. It's a simple formula, current assets divided by current liabilities, and in this case you can see that from 2014 to 2015, from left to right, we'll find that the company has a number that has declined. I mean, it's not a great decline, but it is downward moving. So we can see that obviously the company has lost some liquidity with respect to the current ratio. Bigger numbers are better, and this is obviously moving in the wrong direction. The liquidity needs of the company are actually very important, right? They need to provide for lines of credit. They need to have access to funds when they need them. Smaller companies don't have that same access. So the liquidity is actually far more important than larger companies, because larger companies always have more cash flow incoming, etc. So it's obviously very important. The personal liquidity ratio for an individual is essentially the same kind of formula. Again, in this case, it indicates a number of 10.3%. Basically says that they can cover about 10% of their existing 1-year debt obligations with their current assets. Another ratio to look at is the company's quick ratio, or its acid test ratio. Two important aspects here. Obviously, bigger numbers are better, but we also want to look at the difference between the two numbers, right? We can see the relative importance of inventory, if you will. So for this Bartlett, the number has increased. So the quick ratio has gotten a little bit better. So we're at least a little bit better in a liquidity sense. But the difference between the two is really inventory. If you subtract this, it's roughly 5.4. From here, it's roughly 4.7. So you can see that the difference here is it's a smaller difference, which means inventory is a little bit less in 2015 than it was in 2014. When you're making comparisons to the industry, this is actually a far more telling kind of a number, because you can get a general picture of how important inventory is in the assets of the company, depending on this spread between current ratio and quick ratio. So how does this impact other companies? Again, we can see here, here's Dell, computer company. The difference is 1.3, 1.2. But look at the difference between Home Depot, 1.3 and 0.4. Lowe's is 1.3 and 0.2. The difference here is important because of inventory. Dell doesn't keep a lot of inventory. It's more of a computer company, right? And they build, they don't have a lot of shelf space with computer stuff. They build to need. So we can obviously see that although their current ratios are the same, how they address inventory and manage the inventory of the company is dramatically different. Moving on, we want to talk about something called activity ratios. Activity ratios measure how efficiently management is utilizing the assets of the company to generate sales. So in this case, we're going to use something called days carry inventory, DCI. Sometimes they also just refer to the average age of inventory. But here, essentially, DCI, you can see that 63.99 is 2014 and 50.52 is 2015. This tells us the average number of days inventory sits on the shelf. So a decreasing number could be indicative of a couple things. Number one is it could mean that sales are increasing and inventory is going out the door much more quickly. It also could be that management is saying, look, at 63 days is too much. We have to retract and downsize the inventory of the company to better manage the overall costs. But either way, a decreasing number is a better number. Days sales outstanding is the average amount of time it takes for us to receive our payment from our accounts receivable. And again, you can see here roughly 51 days in 2014 and almost 60 days in 2015. So we have increased by almost, well, a little bit over 8 days. We have increased the time it takes for us to get our accounts receivable. Now imagine if this number was in the hundreds of millions of dollars of accounts receivable. Having even $10 million in accounts receivable outstanding for an extra 8 days is a tremendous loss in revenue for the company. So we want to obviously control receivables. We want to get money as quickly as possible. With inventory, we don't want to tie our money up in inventory any more than we really have to. So keeping control of this gives us an idea of how well management is reacting to the company, reacting to the economy, making decisions that ultimately are helpful in producing profitable operations within the corporation. Now, the days payables outstanding tells us how long it takes for us to pay our bills. And you can see here, 81 days to pay our bills in 2014 and 94 in 2015. So we have definitely stepped backwards with respect to days payable outstanding. But of course, if people aren't paying us quicker, it's going to be very difficult for us to pay our creditors quicker. So we have some issues here with respect to payables. We can also then look at bigger pictures of assets. The total asset turnover ratio tells us how efficiently we utilize the entire asset base of the company to generate sales. And as you can see here, 0.78 to 0.85, we have increased our efficiency. This also is true with respect to the fixed asset turnover ratio. The company is getting more efficient with its use of assets. Lots of reasons how that may happen. Some of those reasons are very constructive, very good for the company, and some of them, quite frankly, might not be as wise for the long run operation of the company. We have this new business. She needs an initial investment of $50,000, and she's going to decide to do this with a no debt plan, right? She's going to invest the full amount and not borrow any money. The second option, of course, is to invest $25,000 and borrow the remainder. We expect to get $30,000 in sales, $18,000 in operating expenses, and we have a tax rate of 40%. So how does this affect the company? Well, here's the no debt plan, right? $20,000, $30,000 in fixed assets, $50,000 is total assets. There's no debt, remember. So we have $50,000 in liabilities and equity. In the end, we're going to generate $7,200 in after-profit taxes. Now, that creates for this owner essentially a 14.4% return on equity. If we borrowed money instead, of course we have $50,000, we have the same liabilities and equity, but we're actually going to have less profit. we have less profit because we have to pay taxes. But how does that ultimately impact the return on equity? And I think this is something that, at least on the surface, isn't intuitive, right? We made less money, so how is it that we have higher returns on invested money? And that all has to do with how much is invested. In this case, you made $7,200 on $50,000. Here, you made $5,400 on $25,000. So it's a smaller piece of the pie is earning a rate of return that obviously then magnifies it. So we want to ultimately then talk about this concept, which is debt. How does borrowing money impact the company? We see that it can increase profits. One of the things is we're going to hope that it helps to increase the overall stock price if possible. So the first ratio just measures the percentage of assets purchased by creditor money. Debt ratio, 44% in 2014 and 45.6% in 2015. So over this time frame, we have increased the debt of the company. Now, is that increase a short-term increase or is it a long-term increase? The next ratio we talk about will help us understand that a little bit, but for right now, we just need to know that roughly 45% of the company's assets have been purchased by borrowing money. The debt equity ratio just looks at the long-term sources. So the debt equity ratio went from 53% to 52%. So the amount of debt for long-term sources has decreased to 52%. So what this essentially tells us is that the increase in the total debt ratio comes from more short-term borrowing than long-term borrowing. Again, increasing debt implies more risk, implies a greater chance of default, but could also indicate an increase in the earnings that come to our owners. The TIE ratio gives us a picture of how well we're handling the amount of debt we have. So the TIE ratio is 3.3 and it rose to 4.4, which means that there is an increase in our ability to cover the interest expenses of the company. Obviously a good thing. And this would sort of make a little bit sense if most of our increase in total debt came from short-term sources, and most of those are not interest-oriented. And then the long-term sources, we have a decline in that amount, so the actual interest expense is declining. We could then make sense. Well, it makes sense that maybe we have a greater ability now to make payment than what we did prior. There is a ratio called the fixed payment coverage ratio that, quite frankly, is kind of difficult to find unless you have information from inside the company. And of course, in this corporation, we have the Bartlett's company. They give us some of that information. I mean, primarily what I'm talking about is lease payments. You really have to dig into the audited financial statements to find out what the lease payments are of a corporation. Those are not typical income statement line items, if you will. How much was actually paid off in debt throughout the year? Again, a little bit of a challenge of finding that number unless you really dig into the statements. But in this case, it just says, look, what is the ability of this company to make all of its fixed obligations? Well, its fixed obligations are obviously lease payments, interest payments, preferred stock dividends, although not required, certainly we would expect for them to, we would want them to pay. And then finally, obviously, you have to pay back the debt. So in this case, we have about almost 1.9 times more interest, cash, to pay these long-term fixed payments. From the financial statements, there is another statement that we can derive, which is called a common size income statement. And essentially this looks at how do the line items of the income statement compare upwards to the sales of the company. And in particular, what we're going to look at are the expense rate or the profit ratios. And those obviously coming here is the gross profit margin. We'll look at that. We're going to look at the operating profit margin. And then at the bottom, we'll look at the net profit margin. But what this does do, though, also is give us some other numbers we can look at. From the cost of goods sold actually increased. So for some reason, we have an increase in the cost of goods sold of the company. Well, that obviously created this decrease in gross profit margin. The selling expenses, though, however, decreased. So it's not the expenses of selling that are driving some of our changes in profitability, but it's these other expenses have increased. So again, it's a place where we can look at year-to-year component parts to see where we are performance-wise on an annual basis. So the gross profit margin, again, talks about the amount left after we paid for its good. Again, let's talk about control, right? Does the company adequately control the expenses of production? Last year's 33%, this year's 32%. So profitability has declined. So something has happened to increase the expenses of gross profit margin. Now, was that good or bad? I don't know whether it was good or bad. We need to ask questions of the production line to find out why this increase happened. Operating profit margin looks at all the expenses of running the company. And of course, you can see here it went from 11.8 to 13.5. So now we have an increase. So we're doing better as far as the total expenses of the company. But we could have even done better if we could have controlled production expenses a little bit more. Net profit margin looks at the total expenses of the company. And as you can see here, that the company has increased its net control of all the expenses of the company. So profitability for the most part for this Bartlett company has been increasing. Earnings per share, a number that I'm sure we've all heard of, is the net income available for common shareholders divided by the number of shares of stock that's outstanding. This is an important ratio as we move forward to try to understand the profitability of the company that belongs to the owners themselves. There's a ratio of profitability called return on total assets. It's the earnings available for common shareholders, essentially net income, divided by total assets. How much profit is generated based on the assets that we've purchased. In this case, you can see 14.2% versus 6.1. So roughly we have about 1.9% increase in profitability. Now we'll talk about this in class, but this return on asset ratio has some problems because since it uses net income, it uses the bottom line, it also includes financing decisions and, of course, the impact of taxation. That makes it very difficult to compare historically if we've changed our financing methods, and it certainly makes it very difficult to make comparisons to competitors and to industries because we all have different financing mechanisms. So we'll move on. Basic earning power isn't provided in your textbook, but I think it's a very important number to understand this impact. How much profit is generated based on total assets? And I don't want to talk about interest and taxes. So in this case, you can see that we've gone from 9.2% to 11.6%. So that's a 2.4% increase. That's essentially it's over a 25% increase in profitability over last year. So the company is providing a lot more profit based on the assets that they've purchased. Return on equity is the measure It's net income divided by the ownership investment in the company. And of course here you can see that it's almost a 4% increase over last year. So profitability wise, the Bartlett company is improving, and in some aspects it has great improvement. It could be a little bit better on the production side, but it is doing much better with respect to creating profits for the company. Now in the end, as we talk through this course, we want to understand that increasing profitability is very good, but from the very first chapter, remember, we really want our focus point to be on price, on stock price. One of the ratios we can use that helps give us a little bit of a picture of this is something called the PE ratio. And the PE ratio is the stock price divided by earnings per share. So what are shareholders willing to pay to get $1 of earnings? And as you can see here, from this year to last year, the increase is substantial, almost double the value. So shareholders are saying that they think that this company has essentially doubled in its value. Its profits have doubled in their worth to them since last year. Big question is, are shareholders right? Are investors typically right more often than not? The market to book value ratio gives us a picture also of value, but in this case it gives an indication of what it costs to buy the company. So in this case, last year, to buy the company you had to pay roughly a 15% premium, 1.15, but this year you'd have to pay a 25% premium to get the company. So the value of the company relative to shareholders has increased since last year. Obviously this is a good sign. Shareholders are happier, but it's also a good sign for the managers of the company, because they've just made the company more expensive to buy. So now companies that may want to purchase your company, merger activity is going to slow down because now it costs more to buy the company. And the final thing we want to talk about is something called the DuPont System. Essentially, it's a very simple analysis that breaks down return on equity into some component parts, if you will. So the return on equity of the company is the earnings available divided by sales. Well, this is essentially our net profit margin. So the net profit margin, right? That's the net profit margin. We want to multiply that by total asset turnover. Here's total asset turnover. Well, you see that the sales divides out, and that leaves us with earnings available divided by total assets. And again, this is our ratio over here, return on assets. So now if we multiply return on assets, right here, return on assets, we want to multiply this by a ratio, and we really didn't talk about it, but it is essentially the inverse, if you will, of the debt equity ratio. So this is what's referred to as the financial leverage multiplier. As this number gets bigger, it implies there's more debt. So in this case, again, if we multiply across, we see that total assets divides out. Earnings available divided by common stock is return on equity. So the importance of this technique is look, how do you get more return to your owners? There's three things managers can do. They can increase the profitability of the company. They can increase the efficiency of the company. And they can increase the debt of the company. Those three decisions will increase return on equity. And of course, from the financial spreadsheet, we can find out how this all works. Now this is referred to as an approximate because most of the industry data that you can get doesn't use net profit. They use EBT divided by sales. So this is an approximate return on equity. So again, you can see it's 11.6 to 16.6. Where did that come from? Well, they have an increase in profitability, they have an increase in efficiency, and they have an increase in debt. So all three of those things are going to drive them towards greater return on equity.